Are we at peak uncertainty? The whole like 1 step forward, 5 steps back that you talk about a lot in your must-read notes. Like, are we done with that?
So look, we're going to hear something on April 2nd. It's the only thing you all are talking about.
Yep.
It's the only thing our clients want to talk about. And by virtue of the fact that everyone is obsessed with what we are or not going to hear on April 2nd, whether there's a sledgehammer or an off-ramp, or what we think more likely, a combination of the two, tilting towards the off-ramp, you are going to get what we think will be peak uncertainty, right? So
we haven't seen it yet. We'll get it.
Well, we are more or less at it.
But I mean, just on that point, though, so you think that April 2nd will be somewhat definitive in terms of where policy is, where it's going? Because it seems like a lot of the market ructions over the last few weeks has had to do with the fact that nobody seems to know. We get one announcement in the morning, and then by the end of the day, he posts something else on social media that almost contradicts that.
No, it won't be definitive in that respect, but I think we'll get a good feel for the tone. And if you go back to last week when Trade Representative Greer suggested that there was more likely an off-ramp, and then, of course, Bloomberg reported over the weekend that it might be a little toned down. And then the comments we just saw about Canada and Mexico are starting to play ball. All of that would lead us to believe that there are more months of negotiations to come, but the beginning of the process of the uncertainty resolution on the part of corporates who've really had difficulty in planning, and ultimately our view is what's going to lead to the capital market cycle that everyone is expecting, that is going to happen.
At the same time, though, the TINA world, there is no alternative, seems to not be there anymore. There are alternatives now, even if some of that uncertainty is resolved, no?
And you know what? It's a good thing. It really is a good thing because, frankly, you get to a point where there is a discomfort around concentration risk. There is a discomfort around earnings concentration risk. And in the U.S., you're going to have earnings broaden out this year. And in terms of the rest of the world, an argument can be made that after 12 years, the rest of the world is going to join the party. And what we've seen going back in history, that even if there is a multi-quarter or multi-year outperformance to the rest of the world, the U.S. boat can float as well.
Okay, because that's what I'm saying. So maybe some of that money that's pouring into Europe, and maybe whatever the end result of that is, that won't necessarily be at the expense of U.S. performance.
It feels as if it has been in recent weeks. The flow data say that it has been. But in terms of the price action and the impact and the re-engagement of the retail investor in this country, who would be very much engaged if there was a little bit more confidence, it doesn't have to be a zero-sum game in the least.
So where in the U.S., if you wanted to play this thesis, do you like right now?
So our view is if you think about what ends bull markets, at the end of any bull market, sometime down the road, you have that speculative phase, you have that capital markets phase, and typically what happens is the bull market leaders tend to lead the charge at the late cycle. And from our point of view, if you look at it's beyond just the Mag 7. One of the Mag 7 we know has had exogenous political type factors associated with it. But a lot of these names have just gone sideways for months on end. And frankly, when you think about how and when and why stocks and markets correct, sideways within a very strong uptrend usually resolves itself higher, and we think that's the story.